Will Deutsche Bank be the next to collapse? Hi, everyone, and welcome to another episode of Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Branko, who's been looking at the banking situation generally, and he's been looking at it in quite a bit of detail over the last few weeks and produced the very informative news article today. How are you going today, Branko?
Good, thanks, Chris. Thanks for having me back on. Keen to have another discussion about another bank that is
Well,
potentially
that's right. Every
collapsing
single
this
week, it
week.
seems we get you back on, and you've got a whole different bank to talk to us about that's under some sort of pressure or going under. What's the deal with Deutsche Bank? Tell us about that.
Yeah, definitely not short for content at the moment, the way things are going. But in terms of Deutsche Bank specifically, a bit of background. So obviously we've had Silicon Valley Bank, Credit Suisse, and now Deutsche Bank. Now, Deutsche Bank, it's credit default swaps, which is basically a way to bet against the solvency of an institution.
Mm-hmm.
The credit default swaps had a massive kind of buying spree, and the margins widened out, and everyone was buying these default swaps. And so that's kind of increased speculation that there's potential solvency issues at Deutsche Bank. Now, there isn't any hard evidence as of yet, but it is possible that you have kind of more informed bondholders trying to hedge their risk that Deutsche Bank, could potentially go under, and further educated investors speculating on its demise.
So these credit default swaps, can you maybe give us a bit of background about sort of what they are? Because we've heard this term come up before in sort of financial crisis and other areas. And when you're saying that these are sophisticated investors, sort of the people who probably know what's going on, who are buying them, is that why it gives it more weight, like as an indicator?
Yeah, well, it's more, generally, you're going to have investors that have maybe some kind of inside information, for example, that are going to speculate in this manner on an institution going under, and they're going to do it in this fashion.
Yep.
I would say that it is a big kind of lesson for bondholders of Deutsche Bank that they've learned from the situation at Credit Suisse, and this may be a way that they're trying to hedge that.
Right, because that's what happened at Credit Suisse, wasn't it? That people who were holding those bonds probably thought incorrectly that they would be the first to be bailed out, and they actually lost everything. And it turned out that the particular bonds they were holding, that was in the fine print of those bonds. You are the first to lose, but a lot of people buying them may not have known that, or might have been trading them thinking, that they were safe, and when they turned out not to be, they learned that lesson this time around, I suppose.
Yep, absolutely.
Yeah. So with this situation in particular, is it you've sort of said there that there's no hard evidence that anything is particularly wrong with this bank. Is it a case of Twitter and the market generally just jumping at shadows here? Because, like, I know you were talking about Credit Suisse for months. You're talking about it a long time ago, and we saw what happened there. Deutsche Bank probably not so much. Hasn't been there, but there's been sort of some rumor about that for some time. But are people just scared now? I know with FTX, for example, that wasn't that long ago. Rumors on Twitter, all of a sudden, next thing, everyone lost their money. So is this a case of narrative just taking over, or how do you interpret that situation? Like how real is it, or how much risk is there?
I mean, with FTX, that was a rumor. Celsius as well was a rumor too, which is very interesting. Remember Celsius, and now that's obviously gone under.
Yep.
But I would say that the interesting thing about the situation is how traditional media is trying to create a narrative of, this was just one rogue trader that had a $5 million position, and that moved the credit default swap market. Similar to like, this isn't a bailout with Credit Suisse and UBS. This is just a corporate agreement. It's like, no, that was a bailout. And this is more than one trader, right? One trader with a somewhat sizable position cannot move a market like this. So it's dominated by institutions and large players. So they're trying to kind of minimize what we're seeing. So that's kind of where the narrative control is coming in. And as we've seen again, it all starts out with just a little bit of movement in the stock, a little bit of rumors on Twitter. And then, like with Credit Suisse, for example, I was talking about that. in October, November last year, and now we're just seeing it. So this could still be thinking it's something that's going to play out over months, but definitely a consistent theme of kind of rumors becoming somewhat true.
And I suppose that goes to the idea of there's patterns that we're starting to identify, isn't there? Because we're starting to see a similar pattern like you've just emerged, but I'm wondering whether those like you've just identified, sorry, but I'm wondering whether some of these patterns are starting to accelerate, because now that there's stress on the system and if everyone's paying attention, do we see some of these things falling faster? So maybe it's not months away that we see real stress in this situation, because unlike, how many times in a row do we need to see a bank fail to identify the signs earlier?
Yeah, and I think the two big points to take away is, number one, like you said, we're going to see accelerated contagion effects. So we're going to see people pull their deposits out of banks much quicker, and then we're going to see these institutions kind of fail quicker as well. But the big thing also to consider is, like we mentioned with Credit Suisse, 17 billion worth of corporate bonds weren't actually basically worth zero once the takeover was completed, because they weren't insured and those investors weren't repaid. So you have Deutsche Bank bondholders now taking precaution because of those lessons learned. And so we could actually see similar sized banks, their credit default swaps now also potentially increase, and more interest in those because of not just for the speculation purposes, but also for those investment hedging. And then that increased speculation will encourage depositors to pull their money out, and that's going to make it more likely it actually does go bust.
Yes.
Yeah.
So with that in mind, do you think that this maybe isn't an overreaction by the market? Do you think maybe this is the smart thing to do?
Yeah, I mean, difficult to say. I think it depends on the individual circumstance, but even though there might not be necessarily hard evidence to suggest it's going under, given the risk reward ratio, if you have your money in a Deutsche Bank or you have bonds or whatever, obviously the risk reward on having some insurance or taking your money out is kind of more beneficial to be a bit, more to de-risk your portfolio, right? Because best case, what are you really gaining from keeping your money in a Deutsche Bank? Where worst case, you could potentially lose, all of it or a lot of it. So it makes a lot of sense for people to rotate their money from banks into things like gold, or potentially diversify their assets into different, banks or whatever it may be. So I think that while it might be an overreaction in terms of the actual evidence that is available, it is the smart thing to do because the risk reward is just so kind of skewed at the moment with the bank going down every week.
Yep. And that makes a lot of sense to me as an individual. And I think if it makes sense to me as an individual, it makes sense to institutions and hedge funds and everyone up that chain as well. I'm sort of interested to get your perspective on this, because the more I've been looking at this stuff, I really don't see a solution in the short term until the yield curve inverts. Because while we've got this yield curve inversion, we've got your shorter term rates being higher. What that means is you've got shorter term rates being higher than longer term rates. And while that's the case, these smaller banks in particular are not profitable, because their model is based on being able to borrow at a lower rate of interest and lend out at a higher rate of interest. So while that yield curve is inverted, we've got a problem. And now with this example, this is not a small bank. Like, you're highlighting the fact that this was the largest bank in Germany. That's what you were saying, wasn't it? Like, this is a massive bank. So just interested in your perspective on this, that we don't really see a solution. We probably see more of this week after week. You probably keep coming back talking to us about another bank and another bank and another bank until we see some actual movement in the yield curve. And the most likely solution to that would actually be rate cuts coming out of central banks. What's your perspective on that?
I think that's a great point, and I think it's difficult to, I think, as we discussed last week, manage this dichotomy where we keep raising rates like we saw, happen last week, but then also we're trying to save these banks by kind of quantitative easing money into the economy. So the end result is actually nothing, because we've got this kind of counterbalance. I think what you're saying is, let's just make the rates, if we're going to do one thing, let's at least match it up, and this lowering the rates will help, in a lot of ways.
Because and I think that's a really interesting way to say it, because if you're going to do one thing, let's actually do that one thing. While we're doing two things, we're doing both of them ineffectively, and it's clearly not working. Otherwise, we wouldn't be on here every week talking about a brand new bank.
Absolutely.
Well, Branko, thanks for your insight on that today, and digging into all that information on the banks. I know it's a bit of work to dig through all that. So thanks for your time to look into it all and come and let us know what you found.
Thanks for having me on, Chris. Love it.
Thanks everyone for watching. Remember, any questions, comments, reach out on the social platforms. Let us know. We love seeing those, and we try to get back to as many of them as we can. That's us for today, and that's us for this week. Stay safe in the markets, everyone. It's a continually evolving situation, and we love to keep our eye on that. Branko certainly will be. So we'll be back on Monday. And until then, I'll talk to you then, but stay safe.